All right, so we're going to skip over to exercise 5. The solution to exercise 4 on your handout is in our Blackboard shell there. I'm skipping over it because it was just another plan assets problem, just like exercise 3, just a little bit different. So I figure we went through one in video, you can work the other on your own and check the solution. Now, let's look at 5. 5 is a little bit different, and that's asking for the full pension entry. So here in 5, we're actually going to calculate the pension expense, the projected benefit obligation, and the plan assets. Okay? So, pension data for Southeast Financial Services included the following. You give us the discount rate. That's the rate in which they determine the gains, losses, etc., or the interest rate on our interest expense for the year. Our expected rate of return is 11%. Our actual rate of return was 10% for the period. That's important to know. Our service cost for the year is $330. Now, this is our beginning balances in our accounts, and then this is our year-end information as well. So January 1, we started with a PBO of 2448. Accumulated benefit obligation. Now, you can read in the book, there's an accumulated, there's a vested, and there's a projected. GAAP requires us to use the projected, which is all encompassing in the future. The vested is the amount if all our employees retired today. So the vested benefit, VBO, is the vested benefit obligation. That's what you would have to pay out today if everybody retired at once. The accumulated benefit obligation, and there is just a little bit different. The accumulated ABO includes those employees that are not yet vested. Okay. So the vested is only for the employees that could retire today and keep their retirement and actually draw. The accumulated would include those that were not vested yet. The projected is what our future expectation is to have to pay out to all employees. So the fact that it gives us the ABO here really isn't that important. What's important is that we have the PBO because that's what we have to record in our books, what we anticipate paying out in the future, the projected benefit obligation. Prior service costs and accumulated other comprehensive income. What that is not a change from the current year, but in the past they've made changes to our benefits, which has created a balance in the PSC. Now, if it made a change this year, they would have to specifically say that a current year change in our benefits created a PSC of, and then we would know that that would be an actual prior service cost adjustment, not just a balance in the account. Here they're telling me as of January 1, this is the balance from prior years in that PSC account. And then a net gain, other comprehensive or additional comprehensive income, additional other comprehensive income. Year 1 amount here is also the balance bringing forward from prior years. So that's the 351 from prior year changes there. Notice it does give us our 1-year amortization. For our PSC, that's typically a straight line basis. So they take your PSC, you divide it by some remaining service life calculated by your actuary, and that's where you get this number. Now your net gain, I'll show you how to calculate the amortization on our gain or loss positions because that really depends on the balances in your PBO and your plan asset. And we'll talk more how they would have calculated that 6 in just a few moments. Then December 31, they tell us cash contributions to the pension fund were $261 million. That's the amount of cash we put into our pension fund this year. And then the benefits paid to retirees were $287. That's the amount we paid to prior employees. Both of those are needed. The benefits paid are needed to calculate your PBO and your plan assets. Cash contributions here is needed to calculate your actual plan assets. All right, so based on that information, let's calculate our pension expense and do our journal entry. Now I'm just going to go through everything as we go to figure out how much we need to put into each of our accounts. So let's start with, and we can start with anything. We can do the pension expense first, we can do the PBO first, whatever. But before we get started on anything, let's first find out what our beginning balances were. Well, it told us we had 2448 in our PBO. Pull it straight off, 2448. And then it tells us our plan assets at fair value at the beginning of the year were 2555. Now, is this pension overfunded or underfunded? And how we know, remember we net the two, and that tells us if we're overfunded or underfunded. We're overfunded if assets exceed the PBO. We're underfunded if the PBO exceeds assets. So in this case, we take 2555 and minus that. So we can just go over here and say 2555 minus our 2448. In this case, we should know we are overfunded, so we have an asset or a debit position in our assets on our balance sheet of 107. That's our starting point. Now I like to just start with the PBO, calculate the 5 things in PBO, then go to you can either do your pension expense next or your plan assets. I then do my plan assets because that's the next 4 items, and then I calculate my pension expense. But a lot of times you'll have most of the pension expense done after you finish the PBO and the plan assets. All right, so the first thing, 5 things go into our PBO. Service cost, interest cost, PSC adjustments, that's if we made a change this year. Actuarial gains or losses on the PBO, again, that's if they change the service life expectancy or if they change the final salary expectations. We have none of that in this problem because it does not mention that they made any changes from an actuarial standpoint. And then the last thing is the benefits paid. So let's talk about our PBO and service costs. Now, service cost hits the PBO, but it also impacts pension expense because for every debit, you have to have an offsetting credit, or for every credit, you have to have a debit. So what's the service cost this year for our benefits? Well, it's $330. So keep in mind the service cost increases our PBO, so that would be a credit to our PBO. Notice 0 impact to our plan asset, 0 minus 330. That's going to place us in an underfunded position at that point, if you look at it, if nothing else changes. We'll talk about that more here in a few moments. Now, what offsets that? Well, remember, we debit pension expense. So it is part of pension expense. We can go along with that as well. All right. Now, what else? Interest cost. What's the interest cost on this position? Well, interest cost would be the beginning PBO balance, which is 2448. And we're going to multiply that by our rate. Let's see here. Find our rate. Our rate here is 8%. So we're basically going to take the 2448. So I'm going to go over here. We'd take the 2448. I'm going to make this and multiply that by 0.8%. Now it is for a year, so we don't have to prorate that down. And that tells me that my interest cost for this year is like $195.86. We're just going to round to the whole dollar. Interest expense is a payable. It increases because it's an expense, so it's going to increase our PBO. So again, if we did 0 minus 196, that's going to be an overall credit position, further underfunding at this point. Now, what else is it going to impact? Well, it impacts our actual pension expense there, 196. So we're going to debit pension expense. We would credit the PBO for that 196 if we were to book each piece separately. All right. Now, the next piece is prior service cost adjustment. That's when we made a change this year. It does not say we made one, so it would be 0. Again, if it did have an impact, it would go there, prior service cost. Next is our actuarial gain or loss. It doesn't say that our actuarial gains or loss existed this year. It doesn't say we're creating any new gains or losses because there was no change to the expected service life of our employees or to the expected total final salaries of our employees. So since there's nothing, we'll put 0. We will have a problem where you have some changes, so you have to be careful. Keep in mind, if you do have PSC, it is called prior, which means it's retroactive. So to get your interest expense, you would need to add the 244 plus this additional prior service adjustment. Then multiply that by 8 because we assume that that would have been part of the beginning number had we changed that percentage in a prior year. So just keep that in mind. If you have something here, it has to get added to that before you calculate your interest cost. All right, and the last thing that goes in our PBO is our actual benefits paid. Did we pay out benefits this period? We did, 287. So we're going to go in and say, okay, my benefits paid were 287. Now, benefits paid do what to obligations? Well, we're paying down debt, so it's going to cause our obligation to go down here. All right. Now, benefits paid does not impact any of the items over here. What does it impact? Well, when we pay out benefits, we simply reduce our debt, reduce our cash or our plan assets. So when I take that down, my plan assets are also going to go down. So I'm going to debit my PBO, I'm going to credit my plan assets for that. So notice, for everything that impacts PBO, there's an offset. It either impacts my pension expense, my prior service cost, or my plan assets. All right, now once we have that, we can go on and do our plan assets. We already have our benefits paid there for our plan assets. Now let's do the other things that impact plan assets. Remember, there's 4 in total. There's benefits paid, there's contributions to the program, and then there's the expected, and the actual returns. So let's start with the expected return. What's our expected return? Well, it tells us our expected return is going to be 11% of our plan on our plan assets, I guess is a better way to say that. So we started the year with 2,555. We're going to multiply that by 11%. So again, beginning period, that's our plan assets, 2,555, times our expected return of 11%. And that's going to give me 281.05. Again, to keep it simple, we're just going to round to the whole, so 281. Now that's going to increase my plan assets. So 281 minus 0, we're going to help offset that funding position there. And remember, expected return is part of our overall expense, and expected return reduces the amount we have to contribute, so it's going to reduce our annual pension expense. Okay. Now the next thing that goes into our plan assets is our actual return. Now in our problem here, on our actual return, we had 10% actual return on plan assets. So we'll do the same thing. We'll go in and we'll say, okay, 2,555 times 10% is 255.5 or 256. So 281 versus 256. We're going to round one, we have to round the other. Okay. Now, keep in mind, we're not going to put 256 in here. We need to bring that down. We expected 281. We only achieved 256, so that's a difference of 25. So we're going to do a negative 25 here because that's 25 less. So again, if we were to net these two numbers, you should come up to the 256. Again, we're carrying to the whole dollar here. We're not trying to round or carry pennies for our numbers here. So the sum of those two should equal your expected. Okay, so that brings the 281 expected down to the 256. And then the last piece of our planned assets is the actual amount of contributions we made. We made 261 in contributions, so that's going to increase our planned assets. Now, what's the offset? Well, let's talk about the offset here. When we talk about our planned assets, we move over here, that would be negative 25 because that's a reduction. That gets amortized over time, okay? So we're going to debit our loss for the 25. We're going to credit our planned assets for 25, and then that would be part of our gain or loss that's amortized over the life of this position, okay? We'll talk about that in a few moments. So notice how everything that impacts has a debit and a credit offset as we go. All right, and the last thing was our contributions. Our contributions here would increase or help to offset our underfunded or overfunded, however you look at it. In this case, we were over to start, then we went underfunded. Notice when we did these first two, we become an underfunded position, and then we're helping to offset that, okay? Now, where does that come from? Well, that's cash, because we have to put money into the actual pension fund, so our cash goes down. So again, notice how you have debits and credits all over the place here. All right, so we've calculated our PBO. We've solved what offsets all the pieces of the PBO. We've calculated the plan assets, and we've seen everything that offsets the plan offset changes. Now the last thing is to finish up our pension expense. Well, at this point, you've got 3 of the 5 already discovered because 2 of the components go into PBO, our service costs and our interest costs. One of the components is part of our actual plan assets, the 281. Now the last 2 things is the amortization of the PSC and the gain or loss. Now the PSC, it tells us here, and this is typically a straight line of some sort of basis, 27. So I simply need to go in and put 27. As I amortize, I debit my expense, I'm going to credit my PSC. So I'm going to go over here and I'm going to reduce that overall position for PSC. Okay, now the amortization of gain or loss. To do the amortization of gain or loss, it just simply tells us that it is a position here. It says we have a net gain. Net gains are carried as credits, so a gain is a credit too. So to amortize that credit, you have to debit the actual gain or loss. So we would need to debit the gain or loss. If we debit the gain or loss, that means we need to credit the expense. So when you amortize a gain, it's going to reduce your pension expense for the year. If you were to amortize a loss, it would increase your pension expense. But really quickly, let me explain how they calculate that. There's what we call a corridor test, and it's down here on our little form, a corridor test. We take our net gain or loss at the beginning of the year and other comprehensive. Now, what was our beginning balance? Well, it told us our beginning balance was a net gain of 351. Doesn't matter if it's a gain or loss, you put it in as a positive number. 351 is the total gain or loss, that's net. Then we take 10% of the larger PBO or plan assets at the beginning. So which was larger, our plan assets or our obligation at the beginning of the year? Well, our plan assets. So if we multiply that by 10%, rounded, we get 256. If your gain or loss balance is greater than your PBO or 10% of your PBO or plan assets, the larger of the two, then you're allowed to amortize something. And in this case, it's 95 larger, so we're allowed to amortize 95. That's all we're allowed to amortize. If your net GL is less than the 10%, so for fun of it, let's say it told us our balance here was 200. Since that is less, we would not be able to amortize any. Okay, we can only amortize gain or loss if the balance in the account is greater than 10% of the larger of the two. Okay, in this case, we're allowed to amortize 95. Now, that's not the amount we're going to amortize. Then we have to divide that by what's the average service life remaining of our employees. Now, this number has to come from the actuary. Nowhere in here does it give us that number, so I sort of had to make it up. So we know that based on the information that they have 16 average years. And again, I made this up. It is not in the problem, but I want you to see how they would come up with it. The actuary says, hey, the remaining service life on average of all your employees is 16 years. So then to come up with your actual amortized amount, you take the amount you're allowed to amortize and you divide that over the service life of your employees and you get 5.9 or 6. So if we look here, notice it says our amortization for the year for our net gain is 6. That's how you come up with that number. Okay, you do what we call the corridor test. To do that, you have to have the average service life. It didn't give us the service life here, so I just made that 16 up so that my math worked out right. You take the excess amount, 95, divided by 16. That gives you 6 that we're allowed to amortize. And that's what becomes the amortization here. If it's a net gain, it's going to reduce our pension expense. If it's a net loss, it would increase it. So now that we have that, let's just do our sum so that we can make sure we're in balance. Because if we're not, we're in trouble. So let's make sure. So we got a pension expense there. That answers question 1 of 266. Carry this across just to get our balance. Make sure, if I highlight those, notice my sum here is 0. That means I am in balance. I have a debit for every credit. Yay. So that gives me some hope here. All right. Now, this is our accumulated OCI positions. How much should we have during that period? Now, this one actually should not be highlighted because there's no need for that. So let's put that. Now, our beginning balance, it told us, was 346 and 351. Now, that would be a debit balance. This was a net gain, so it would be a credit balance. So here, we had a net debit of 346. We credited for 27, so we're going to take the 346 and we're going to net it with the 27, and that means we now have a new balance of 319. Then we had 351. That was a credit balance because it's a net gain. We debited the account for 31, so we're going to net these two. Our new balance is 320. So the actual amount we would show as accumulated OCI would be 1. Okay, it's a net position of 1. All right. Now, how much are we under or overfunded? Well, we had 107 overfunded. We're crediting for 9, so that means at the end of the day, we're still overfunded only by 98. We had 2448 in our obligation. We credited it for 239. So at the end of the year, we have 2687 in our ending PBO. And our ending plan assets would be the 255. We debited for 230, and that means 2785. The net of these two numbers hopefully come back to the 98 change there. That tells us that we're still in an overfunded position. We would show an asset on our overall balance sheet. Now that we have that, we can do the journal entry. We know our pension expense, we know our PBO, we know our change in plan assets, and we know all our amortization numbers. Now, keep in mind, this column here, these two columns, you have to be careful with. Why do I say that? Well, we have to journal each of these positions separately. So if there was a number here, 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 and here, we must journal these separate from the amortization because they're two different things. All right, so I'm going to pull this off to the side and we're ready to journal. We'll go through and I'll show you how we create this journal entry. All right, so first and foremost, we found our pension expense to be 266. So that tells us that. So year one, to do our journal entries, we're going to debit pension expense. Oops, caps. There we go, pension expense. We know we're going to hit that for 266. We've already found that number. All right, what else do we have to hit? Well, pull this back over here into our screen so we can see. So this is going to be a debit. This is going to be a credit to cash because it's negative. Now here we have to be careful. It is going to be a debit. Well, there's just one number. Since we have a zero there, we're good. Okay, so we know here we're going to have a credit to our amortization of PSC. Here we're going to have two entries. We need to increase our net gain position, or reduce actually, because we had a loss there of 25, so we're going to reduce that. And then we're also going to record our amortization. So we'll talk more about that here in a minute for 25 and 6. These have to be separate entries. And then the last thing we're going to do is the net of 9, and that's going to be a credit to our PBO. I'm just going to put credit there. And it's going to be a debit to my plan assets. Okay, and the sum of these two will give us that 9 change. All right, now that we have that, let's go through and actually create this journal entry. So we did plan assets, or excuse me, pension expense. We knew the plan assets needed to be a debit of 230. I'm just getting my debits first. Then we've got our net loss for other comprehensive income. Net loss there was 25. That increases that position. And what happens is that will then get added to the number that we're amortizing over time. Then the other thing that was a debit, notice if I were to pull this back over here, the other debit in our transaction here was for the 6 for our amortization here, because we're amortizing that net gain position, I believe. Let's go back to the problem here. Yes, net gain. I thought so, based on direction. Just want to make sure. So as we decrease a gain, we debit the gain account and credit the actual expense. Okay, so go in here and we're going to hit our amortization of the net gain. Oh, I cannot type today, my apologies. Of net gain, and that goes to OCI there for 6, or to keep it consistent, say OCI, additional comprehensive, other comprehensive income, or accumulated, excuse me, other comprehensive income. All right, now what else do we need to do? Well, we need to credit, so the negatives are credit, cash, our other prior service costs, and then our PBO. So that's the 3 that we're going to credit. So amortization of, there I go again, INT backwards, of our prior service costs. And again, this is other comprehensive income there, and that's 27. Then we said we need to go in and we need to hit cash for 261. And then last but not least, we go in and we hit our PBO for 239. And again, our plan assets at 230 and our 239 here create that balance of 9 overfunded that we saw in our handout right there. So now, once we've recorded that, we are completely finished. We've got our entry, we know what our pension expense is and what our final balances are, and we've recorded them in our journal. So hopefully that helps clarify. There's a couple other pension videos that go in even more depth, so make sure you watch those as well. I'll be posting the solutions for the rest. So if you look down, exercise 6 is actually just the corridor test, which we just went over how to do that, so you should be able to do it. And then problem 7 is, again, just another pension expense, and you go through and you figure out, just like we did in your pension worksheet, to figure out the balances in your accounts. Okay, so I'll post the solutions for these. You should be okay if you watch the videos we've done and the other pension videos that are out there. Thank you and have a great day.